Hey everyone, it's Alyssa Corm and Mike Webster here to give you a detailed look at some very exciting updates that we've made to a lot of the tools and premium lists and products that you use at IBD all the time. And Mike, I want to kick things off with a little bit of background because you're a very humble guy. And I don't think a lot of people know just how instrumental you have been over the many years
Are you
of
calling me old
creating
already?
things.
We're just
I am calling you a
starting
little
and you're going to
old.
call me old, Allie? Is that where we're going?
Yes, I am. No, you are very wise and experienced and the right guy for the job for all of these incredible updates that we have for everyone. But why don't you give us a little bit of background to just let people know all of the experience that you have had that has really gone into being a major orchestrator of what we're seeing here today and bringing to the table for everyone.
Well, hey, thanks for that. And this has been so much fun. I love building things. And I started building things for Bill back in 1999. I started at the firm in 97, and then I worked on my first product, which was actually an IBD product, the stock checkup. And that was my first creation. And, was involved with, everything from, bits and pieces of the launch of investors.com, mainly through creating that stock checkup. And then over the years and decades, I was able to build a lot more things, both on the institutional side that I did with Bill, that we created a lot of products, both paper products, if folks remember what those were, like printed books with charts for institutional clients like hedge funds and mutual funds. And that was a ton of fun. And then things for the software side of things, which we had our institutional side of things. And I was, a senior VP and the director of research and development for a time at WAN. And I built a lot of things in their Wanda product, which then would ultimately get filtered through to, what ours were, which originally was Daily Graphs, the print book, and which I did some work with them on that too back in the day. And then Daily Graphs Online, which morphed into MarketSmith, that is now MarketSurge, and now MarketSurge 2.0, which we're super excited about. So I've been able to do a lot of things behind the scenes and in front of the scenes of building things from, the composite rating, the 3-month relative strength rating, the growth 250. Took over a decade to build the pattern rec that you see, and we're going to be talking about all those today, and lots of other things that I've frankly forgotten that I've invented. But I love inventing things because I had a great role model with Bill. He was inventing things before both of us were born. Even me, before I was born, he was coming up with things and designing things, and working with him directly, creating stuff for him and with him was just such a wonderful experience. And so I got to see how he thought and how he, would like to build things. And I'm just trying to take what he originally did and that direction and just keep going, continuing to go with that, with, anything at IBD, whether it's MarketSurge, what we're talking about today, or with the paper side of things or investors.com.
Exactly. So you just have this immense foundation of institutional knowledge and that close working relationship with IBD's founder, Bill O'Neill, over the many years, informing what you're doing here today. And I think it gets a lot more technical than people may even realize the logic, the code that you're going through. And this has been a very intense process with a lot of checking and reiterating and perfecting. And, I think like Bill, you are always wanting to improve. So I feel like this is kind of just the beginning, so to
Yeah.
speak, of
This is
this
called
journey.
I'm calling it phase 1 because with all of the changes we're making, it's the first go round. And that's how Bill was too. He was always iterating, whether it was the newspaper or our printed products or online stuff. It was never good enough. And it's just like, like an iPhone. You had the first iPhone and then the Steve Jobs kept on iterating and making it better. It's the same thing. And that's what we had as a role model, was just someone who always wanted it better and it was always tweaking things, never happy. And that's how we are. And so we're going to be talking about the new this new major change that we made with everything, major improvement. I'm super excited about it, but it is just phase one because we know where we need to improve and what we want to improve on. But this is I'm so proud of the team and everything we've been able to accomplish, and we've got a lot to still do, but it's now at a place where we're ready to show it to everyone, and I think it's going to help people, you know, what Bill would always say, save time and make people money, and that's the goal of our products. And I think each one of these things we're talking about is targeted for that, for saving you time by whether you're using the Growth 250 or our ratings that go into the Growth 250, or using the pattern rec to help you, know where to buy, or where the ideal places to buy, and all the bells and whistles that come along with that. And it's just to try to save you time and money, because time is money. And so I'm super excited, not just to share them with everybody, but to use them. Really,
Exactly.
it's fun. It's fun stuff.
Yes, couldn't agree more. And you're the perfect guy for the job. So we are so incredibly lucky to have you leading the charge here. But let's get right into it. And let's start with the Growth 250 and the major overhaul that you've done to the Growth 250.
Yeah, so this is one of my babies of each one of these, and I'll just start at the beginning because I think people would need to kind of understand what the product is, where it came from, and now where it's going, which is kind of going full circle. And you'll see that in a second. So, yeah, I don't remember what year it was, but probably over 15 years ago, I was tasked with. They said, "Hey, there was always this kind of intercompany competition, healthy competition between IBD and MarketSmith, which is now MarketSurge, but at the time it was MarketSmith." And it was like, oh, each one wanted to be better than the other one, which is a good thing for an organization. So on the IBD side, we had the Big Cap 20, and we had the IBD 50, and we had the weekend review, which most people probably don't know the weekend review, but I always loved it. It was, basically the EPS above 85 and the RS above 85 within 15% of your highs. And that would give you a much fuller list than the Big Cap 20 or the IBD 50. So you have these three major lists plus a bunch of other things that we built over the years and decades. And they tasked me with, hey, let's create a list in MarketSmith. And I'm like, wow, I don't want to confuse people, because it was already so many different ways of just looking at stocks, and a lot of the stocks would be in the same one. And I didn't want to add confusion. So originally I thought, you know what, I'm going to build something that is the only list you need to go to. And I codenamed it the time saver. That didn't end up sticking. The firm went with the Growth 250 name, and I guess it's kind of cemented at this point, but I always think of it as my time saver, because that was the intent, was rather than to look at this list and create your own custom screens, was to just have one place that you go that would get almost everything that you needed. And so my goal was to always get 95% of what I would find through all the thousands of stocks I look at every day and in every week. And I know that most people don't do that. I mean, if you don't know, if folks who don't know me, I look at about 5,000 charts a day on average on a slow day, and have for decades. And that's just what I like to do. Most people have a life and don't want to do that. So that's what this is for, is kind of taking that knowledge and putting it into just one list. So then I was like, okay, how do I create this list? So I utilized something that I'd built for Bill, and then kind of just built on that. So originally, every weekend, Bill and I would both get these printed books that had some custom screens behind it that I developed, and that's how we would do research for this list that we managed together, kind of like what the team does with Leaderboard or Swing Trader, but on the institutional side. And it was called the New Stock Market Ideas, and I managed that along with him and other people as well. And so for that, every Sunday we would talk and go through, okay, what did I find and what did he find, and what stocks are we gonna add to the list, and what are we going to remove? And that was a big ticket item that we sold to mutual funds and hedge funds. So to get that list, I, wanted to really just kind of narrow it down to what were we really going to consider for that list. Because we would both look at everything. He would look through the stock tables in the newspaper, and then we had these two big books that were called database books that had about, I think about 2,800 stocks in there. And we would both go through both of those. But then we wanted something that was just like the cream of the crop. And that's was the basis for the Growth 250. And how it came about is I just created a bunch of screens, merged them into one list, because that's the first thing is like, if you get Bill's book and you're like, okay, I'm reading it. I'm going to fill in all of these different things. He says the return on equity has got to be above 17. The relative strength's got to be above 88, and all these different things. You plug it in, you come with like no stocks or maybe a handful of stocks. So there are all these like or statements behind it. It's like, oh, it either has a return on equity, or it has a pre-tax margin, or it has a high relative strength, or it's got really good fundamentals, or all these or statements behind the scenes that I would build into those. And then come Monday, he would just give me a stack of charts and say, I don't like these. Not with any like, this is what's wrong with them. It was fun for me, because then I got to figure out what was he seeing in his eyes that he didn't like in those charts, and or with those stocks, whether it's fundamental or technically based, or their group or anything else. And then I just kept on adjusting those every week until I no longer got a stack of charts from him, and he was happy with that list. So that was the core thing that we would use on Sundays. So when I was asked to build a list, I'm like, okay, I can start with that as my foundation. Then the next thing was, everything that we do here at the firm is based off of model book studies that Bill came up with, again, before both of us were born. And I built, tons and tons of model books for him. And that was one of the tasks I did with Charles Harris. And it was a lot of fun, and it was a lot of work. And we went all the way back to the 1880s and filled in that space that we had never studied. So that's where you learn. That's where Bill learned. And so I thought, okay, I've got this list that Bill's already happy with, but I'm tasked with this thing, the kind of self-imposed task of making a list of all lists, like the best list. And that's what the goal was with the Growth 250. So I said, okay, I'm going to go through these model books, and I'm going to go to page one of the first one and say, would my screens have gotten this stock at the beginning of this move? And if so, go to page two. And I would do that. And when there was one that wasn't making it through, I'd write a new screen around it and then put it in there. And ultimately, it ended up being over 30 screens, plus a bunch of procedures that happen in the background, a lot of secret sauce type of stuff that gets you back into this one final list. And that's what I came up with. And over the years, every few years, I'd make a couple tweaks here and there. But at the core of it, it hasn't changed that much until now. This is really kind of a major improvement. Because as we were making all these changes, updating all the ratings, changing the which we'll talk about in a little bit, changing pattern rec, changing, obviously the foundation of MarketSurge to our new platform, which is just bigger and better, and it is a foundation for us to build upon. That we were also like, okay, let's revamp the Growth 250. If we're going to do all of this stuff, if you're fixing everything on your house, you better like paint it as well. Like you don't want to not take your crown jewel and make it better. So I went in there with a fresh mindset of the different things I've learned over the decades and put it in there. So now the new Growth 250 incorporates things like average true range in a pretty big, heavy way. RS lines, before it was just kind of RS lines at new highs. Now it's heavily based on RS lines and their moving averages, as well as all the fundamentals and all of those or statements that are very, very, very important with this product. So to give people a kind of an example of each one of these screens, I would target it to one specific item. So let's say I was going to look for IPOs, recent IPOs. That screen is going to be completely different than if I'm doing another one that's on stable earnings, or another one that's on pre-tax margins, or something that's just price-based, like something that's just ripping up, but it doesn't have the normal things that we would look for yet, because things do change. And over the years since I've built this, the market has changed a lot to focus more on sales growth than it used to. It used to just be kind of earnings growth, but now it's both sales and earnings. And sometimes, especially in the software space, when that area is working, that you don't have the
Yeah.
earnings yet. And so I wanted to make all of those changes to get those stocks in there. And that's what we did, and just revamp things in a real major way. And as I was doing that, there was a little bit of a problem that we had limited the stocks to 300 names. And originally, when I came out with it, 300 was too small, and it really was too small. 350 was the right number, but we were getting a lot of pushback from customers who were saying 350 names. That's just too many to look through. And I get that, because for a normal person, 350 would just seem like overkill. But if you know how to go through it, you can do it very quickly. And I always time myself, every few months or so, because people always ask me, how can you get through all of those names? How long does it take me to get through them? I timed myself again yesterday. It was 14 minutes and 1 second. And I was doing it while I was working at the same time. So it's very possible. Maybe the two of us in the future will do some videos on how to get through
Yeah.
the Growth 250 that quickly, because there's a method to it. And the tool, we've got some things like the flag button that you can hit the F5 key that really can speed that up. But that's a topic for another day that we'll circle back. So I had put the limit to 300 because I was asked to. And I thought, you know what? It had always bothered me. So this is our chance to change it and to go back up to 350. Then we used to have a floor in there, meaning an artificial floor, where if you were in a terrible market environment, that you would I had some other screens that I called filler screens that would just fill up the book to at least get, we had different values at different times, like 80 or 100 names in a really terrible bear market, just to have something in the product. And that bothered me. It really did. And so I removed the floor, because we shouldn't have a floor. If the market is so bad that there's no stocks making it through your
Right.
screens, there's no stocks making it through your screens. It'd be highly unlikely for that to happen. But you could see a very, very small list. In the reason for the Growth 250 to always expand and contract was to give you other information. And if
Exactly.
you're maxed out at 350, then you're in a decent environment where there's merchandise to pick from. As that shrinks like an accordion, it's giving you that feedback. And so what I would suggest people do is every week just kind of make a note. Oh, how many stocks made it through this screen? Now, eventually we will put something in MarketSurge up at the top that kind of just graphs that along, so people can see and use it as their own extra indicator of what is out there, the quantity of stocks within our universe, because that's really what the Growth 250 is our universe of stocks to pick from. So, think of it as a pond to fish in. And I just wanted to make that a really, really good pond. And I'm very happy. Like I'm thrilled for everyone to get to see this, which they're going to see it in a few, very shortly, probably later this month. And I just, you know, want it to help people do what? Save time and make money. And I'm now using it on a daily basis again. Before I was kind of use it and I would mix it in with some other screens, but now this is going to be my core thing that I do. So just kind of to recap, I've gone through all the different screens and I've adjusted every single one of them. We've changed the amount from the max from 300 up to 350. It will be an accordion in expand and contract. It can go all the way down to 0 names. Highly unlikely, but that is possible. And that should give you some information. If you only see 20 names in there, you're probably in a pretty bad market. Hopefully that doesn't happen in our lifetime, but you never know. If 1929 happens again, I'm sure there won't be many stocks in there. So the goal is for you to just not have to look at a bunch of other lists, not to have to do other screens. If you want to, because it's fun, because you're a geek like me, then
Right.
do it. But you don't need to. All you need is the Growth 250, in my opinion. That'll get, I think, 95% plus of the names that you would want to be looking at to buy. Now, it's very important to note that it's not a buy list. It's never been intended to be a buy list. If I wanted it to be a buy list, I would design it differently. And there's nothing wrong with that. We could eventually design something that is a performance-based buy list, but then you have to do both the buys and the sells at a certain way. And that's not what this product is. This is an idea generating product where it's okay, what sectors are hot? What areas in there, what industry groups look good? What's working? Is it the big caps or the small caps? And everything in between. Some of the other changes you'll note on here is I increased the liquidity substantially. In the past, people would always ask, like, why are there so many illiquid names in there? And that was because there were some very key stocks, one of which was Taser, which is now Axon, that had its move. And when it broke out of its pivot, it was about 12 bucks. And I think the average volume was around 50,000 shares, not dollar volume. And so that's tiny. So I always wanted to have it be something where you didn't have to worry in the back of your mind, am I missing anything? So I wanted to have thin stocks, be able to make it through, but they were getting too many of them in there. And because most of us don't trade thin stocks, so your liquidity is increased. And you'll see that I've improved the anti-turnover, which is a concept that basically means if it can't fill up the full 350, what I do is I go back and look at the prior week's list, run a separate filter on there and say, is anything from last week's list that maybe didn't make it this week, should it still be on the list? Yes or no? And if yes, and if there's space, we put it in there to kind of slow down the turnover. But you do want a decent turnover because that gives you a feel for what groups are falling out of favor and how are things going. So it's really a balance there. I
Mhm.
will I assume I'm going to make updates in the future, because I always like tweaking things, but it's pretty much at its core right now. This is a major upgrade. I'm so thrilled for everybody. I'm thrilled for myself because I want to use it every day. So I said a lot, Allie. What questions do you have?
You were very thorough. A beautiful crown jewel, and I can't wait to use it either. So that's incredibly exciting. Can't say it enough. Mike, you mentioned the pond we're fishing in. I think that's a great segue to our next topic, and that is the overhaul of our ratings.
Yes.
So the universe that we're looking at for stocks and ETFs really plays into that. So let's discuss all of the updates to our ratings.
Yeah, so I'm thrilled that we are making this major, major upgrade on every single one of the ratings. So I've gone in and everything from the EPS to the SMR to the composite rating to it, all of our ratings have been updated. And I was by me, and I was so privileged and to get to work with Justin on the accumulation distribution because it's fun working with him and he's such a smart dude. And so we got to tackle that together. And we're going to do a phase two on that because we already saw some things we want to tweak, but that was fun. But all the rest, it was just logic that I had been thinking of for years and wanting to do. And when you create something like Bill created the EPS and the RS again, way, 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 decades and decades ago. And over the years, what he would do is occasionally kind of see a stock that, didn't have the right number, that the number that he thought was right. And he'd make a couple tweaks here or there and really bonuses and penalties. And there are things that needed to be cleaned up in there because sometimes they have negative, unintended consequences whenever you make a change. When you do anything is kind of a teeter totter. You di- dial a knob this way to get this stock to have a higher rating. Well, it brings something else lower. So you really have to be careful when you're tweaking things. So we went back with a fresh mindset with each one of these, and I wanted to stay as close to the original concept as we possibly could because these things have stood the test of time over decades. And so I didn't want to go in there and just throw it out, but I wanted to go in and say, okay, where could we make tweaks to improve it? So, for example, like the EPS rating, historically we'd only looked at the most recent 2 quarters. So now we look at 3 quarters and change some of the weightings around a little bit and kind of smooth things out and got rid of some bonuses and penalties that no longer made sense, to kind of smooth that one out. And the same thing with like the relative strength. There's three relative strength ratings. There's the original one that we just call the relative strength. I refer to that as the 12-month because it goes over 12 months. And there were some problems in there with like drop offs, what we call refer to as a drop off in price, meaning at some point at a key level, the way it was before was we double weight the most recent quarter, and then we would equal weight the prior three quarters, and then put all that performance together and rate all the stocks in the database, ETFs and stocks, everything under the sun from 99 to 1, which we'll circle back to in a moment of why that's problematic. You just sort everything that way. Now, if your stock had a big gap, let's say at one of those key thresholds, like 3 months ago or 6 months ago or something like that, you would see this big change in the rating on when that dropped off in time, and that always bothered me. I'm a kind of a clean data freak, so I put in with all of these things just more time variables in there. So the same basic concept, but just more focus on recent and more gradual things. So as things are coming way off their highs, you're not going to
Perfect.
see that 99 relative strength on something that's 50% off its highs as often as you see now.
Yeah.
Um, Go ahead, Ali. I'm sorry.
I was just agreeing with you because I was gonna bring up the example, like, SMCI comes to mind.
Yes.
Remember when that went on that huge climactic run and then
Yes.
cratered, and it had the 99 for too long, so
Way too long. So along those lines, back in 2000, the SMCI of those days was Qualcomm, and that bothered me so much because it had a 99 relative strength because it had gone up 2,000% in 99. Bill made probably more money off that stock than any other stock. But then in 2000, it topped at the beginning there, and then it came down quite a bit. But because over the last year, it was still up so much for the entire time frame, it was pinned at a 99. It just bothered me to no end. So I went to Bill and I said, "Hey, you know what? I think we should do a 3-month and a 6-month relative strength rating to fix this problem." And he's like, "Yeah, I totally see the need for that." And then when I went in there, because of this drop off effect that I knew was happening, I went in there and did it on a really essentially an exponentially weighted type of formula where it would put more weight on the most recent action than on, the last day of it. So this kind of just more weight on today than yesterday, more weight on yesterday than today. We still have that. I've kind of adjusted it a little bit to smooth out and kind of where I knew that there were some problems, fixed it. But essentially, that's what we're after is we had originally left the RS 12 alone or the standard RS, and then I just included this 3 and the 6 month. This worked really well. Now, when I did that, and this is where it's kind of important and an important part of the story. So this was probably over 25 years ago, or maybe between 20 and 25 years ago that I created those, that I did what we're finally doing for all of our ratings now. I made it off of a universe that made a lot more sense than everything under the sun. And so this is the big change that you're going to see in all of our ratings, with the exception of the accumulation distribution. We'll circle back to that at the end. So all of our ratings right now is the entire database, and they're just dumped into one pile, whether it's an ETF or a stock or something that's um, a low
highly
quality,
liquid. Yeah.
illiquid, low market cap. I'm trying to avoid the word junk, so I won't say the
The
word junk.
excluded stocks.
Excluded stocks. Not going to call them junk. I'm just going to call them excluded stocks. So you've got these stocks in there that no one really wants to trade, but you're creating a relative performance on there. And so I want to make sure that we don't assume any knowledge. The 1 to 99 rating that Bill came up with is genius. And what it does is it just takes the top percent of whatever the item you're looking at and gives it a 99, and the next 1% at 98, and so on. So your bests are going to have a 99, your worst are going to have a 1, and it's on a relative basis, and that helps out a lot. And And, if you're in a bull market, things are going to be rated different than if you're in a bear market. And so you can't look at just a raw, like what was up 50% or more over the last 12 months, because that's going to be completely different in 1999 than in 2001 or 2008 versus 2006. So it, the relative nature of it is very important. But then if you're a clean data person, you're going, wow, do I want to compare this against everything? And with those relative strengths, the 3 and the 6 that I developed way back when, I said, no, that's just silly. And it was, at the time, it was only on the institutional side. It wasn't for IBD or MarketSmith, which is now MarketSurge. So it was just on our WAN products. And I said, you know what? Let's just compare it against what our clients and what we are truly looking at, and look at that universe. And I'd mentioned earlier those maroon books that Bill would get. They had about 2,800 stocks or so in there, and they're based primarily on liquidity and a few other things. So I did that plus another subset of some things, to include IPOs and things that wouldn't have made it through there yet. And that's what I created the 3 and the 6 month relative strength on. Now, I think somewhere along the years, I think somehow it got changed and reverted back to the full universe. And that always bothered me. And I couldn't wait to put it back to its original state. So that's what we're doing now with all of our ratings. So I want to be very clear about this, because this is a major change and a major upgrade, that we are now rating our stocks, whether it's the EPS, the RS, the SMR, we're rating those against stocks that you should rate them against. We're removing stocks in there that have tiny market caps, or maybe they haven't traded for a few weeks in there. And so if you've got some stock that hasn't traded for 2/3 of the time over the last X number of days, do you really want to, regardless of what the reason is, maybe it's halted, maybe it's going through some sort of issue, it's not something you really want to rate your performance against, whether it's fundamentals or technicals. Or if it's this tiny, tiny stock that we can show some of those in a few minutes, that there's not in the universe. You're not going to buy this stock that's with the IBD methodology, that's a 50-cent stock that's got a tiny market cap. You're just not going to trade those. Most people aren't going to, that are following the system. So why have those as a comparison? So we remove those. In a nutshell, it's what we remove from the universe of stocks that we are including are things that are very low market cap. So let's say 50 million or less market cap if it's a New York or a NASDAQ stock. And if it's not, then 100 million market cap or less. Then that created another problem. Like, what if something is right on the border there? Today it's 100 million market cap, tomorrow it's not, then it's on, then off, back and forth, because that does happen a lot more than you would think. So I wanted to create kind of an anti-turnover there as well. So I basically just say, I'm going to look back over the last quarter. If at any point during those 13 weeks a stock was included, we'll just keep it on there. We want to include everything that we should include, but but we don't want that list going all over the place. And so
Fluctuating too
this week it's
much.
got a composite, next week it doesn't. So that's what we did, that anti-turnover. So it's a 13-week time frame that we look back at. The next thing that we did was just go in and just say, okay, I want to compare apples to apples and oranges to oranges. So why am I comparing Apple, the stock, with the Qs or the SQQ or the TQQ? It makes no sense whatsoever in my mind. So what I did is for the relative strength of 3, 6, and the 12, we just exclude the ETFs. But we knew that everyone would want to have ratings on their ETFs as well. So we just compare all those to each other. So all those oranges are compared to each other. So if you see a relative strength rating of 99 and it's an ETF, well, that's a 99 versus all the other ETFs, which there is about 5,000 of them. And if it's for a stock, then it's against any of those that are in our universe of stocks that we deem that it's big enough. Now, over the years, we're kind of making baby steps with this. I wanted to make sure everyone got comfortable with the smaller universe. And then once people do get comfortable with that, we'll probably tighten that up a little bit because we're not excluding that many stocks. So
Yeah,
we
it's really
really
not that
wanted to be on the
many.
safe side. Yeah.
The list. We wanna show the list
Yes.
to
Oh,
show some
that's just a
examples?
small subset. There
Okay,
was a
it's a
lot more,
subset,
but I just wanted to give you 50
a
or
little
so.
subset.
Why don't we play through them?
Yeah, just some, examples here of what you're talking about that are in our excluded list here. So, yeah, I mean, 64 cents a share, teeny tiny market cap. So, that would be on there,
Yep.
and we can play through like you
Yeah,
said.
you can just hit the play button and you can just see that these are all things that, and you can even go to the monthly chart if you want.
Sure, yeah, because they're a lot of them are in the dirt, it's
Yeah.
hard to
I mean, it's a
it's hard to see.
2-cent stock. So these are the ones, again, they have such a small market cap. But in
The
there, that why are you going to you're not going to trade this stock, or most people, maybe there's somebody, and I, no offense if you like trading like this, there's a subset of people who like trading this style, and I don't want to offend anybody. It's just not part of our method. And so there's a different method for every style of trading. But so this stock, a 7-cent stock with a market cap of 64,000, let's go back to it. Um, Looks like 64,000 market cap, and it's a 2-cent or 7-cent stock. Why do you want that as part of any of your ratings that you have? And it's the same thing with all of these. Now, some of them weren't making it through for one reason or another through some of our ratings before, but a lot of them were getting ratings that you wouldn't have wanted, and so that's why we just did this cleanup on there. And this was just a small subset of them, but we've got. We also don't do finance blank check stocks, because when those happen, they just kind of flatline it at $10 until they actually do a merger and then they get assigned to an industry group. So we exclude those as well as any closed end funds. And so things that just wouldn't make sense aren't part of the universe. And you can just hit the play button or just show a few more if you like. But I think people will understand why you don't want to compare your stock that you're thinking about putting your hard earned money in versus one of these. It just gives dirty data for
Yeah,
your 1 to 99.
exactly, it's skewing the data, so that makes a ton of sense to me, Webby. Definitely worth the cleanup there.
And so let's kind of, and we can stop sharing. I think people get the idea. If you want to screen still, and you want to include something that might be in this excluded pile of stocks, no problem at all. Just go into your custom screen that you've built and just don't put on one of our ratings, like the composite rating, the RS rating, the EPS. But you can keep all your other parameters. So you'll still be able to screen them. You'll still be able to see everything. You just won't get one of those ratings for it. So I think it's kind of the best of both worlds where you still have access to it, but it's not part of the rating. That makes sense, right, Ellie?
Absolutely. So, a lot of secret sauce adjustments, some smoothing that was done. Anything that you wanna go over in more detail with
Sure.
EPS, SMR, RS, uh, and
Why don't
comp
we
before we go
tackle
to
them?
AD?
Yeah, we'll tackle them one at a time because they all got
Great.
touched. So the
Yes.
EPS, we already kind of touched on
Mhm.
it, that we went off to 3 quarters and we smoothed out some things, both because we still look at the 3-year growth rate, the 5-year growth rate, as well as their stability rate rating of each one. So we have kind of a cleaner way of looking at each one of those. There were some loopholes in there that we removed because they were just problematic. So it was a lot of this was cleanup of but I want to stress we wanted to keep the core concept of all of Bill's original ratings because we didn't want to just change everything. So it's just improved. And frankly, I knew where it needed to be improved because there were things that bothered me, you know, all the time. That it's kind of where that's part of the secret sauce of how we were able to fix that. So that was the EPS. The SMR is is now a great rating. It was a rating that I didn't really like that much because it was problematic. It's sales margins and return on equity. And the concept was sound, that we didn't just look at the earnings, that we looked at sales, margin, and return on equity. But there was some problems in there, just some technical problems that I want to bore people with, that we fixed, because sometimes just for some timing issues, you wouldn't get a rating at all on an SMR and for a period of time, and then it would pop back in. That had a big impact because it wasn't just that your SMR wasn't there. That so if you were screening at the time, if you had an SMR in there, it was problematic, because if you said, okay, I only want an SMR of a B or an A, well, if it used to have a B, but then all of a sudden for a while it's gone away, well, it's not going to make it through there. That's very problematic. The the other thing is, we just wanted to look at it in a fairer way. And so in the past, it was mainly on annual numbers, but on a quarterly basis, it's just more granular and you get more information that way. So that's why we kind of just looked at more data points to keep it on the simple side and balance some things out, and made it so anything that's in the list, meaning it's not in the excluded list, that it will get an SMR at all times. And then that flows through to the composite rating, which is a key, it's one of the key components of the composite rating, which we might as well talk about next. So
Great.
that was the SMR. So the composite rating, that was a fun one, and it is near and dear to my heart, because that one came about from a phone call that Bill left me on a Saturday on my answering machine. And so it meant he couldn't wait until Sunday to talk to me, because we'd talk every Sunday night. But he's like, Mike, we're confusing people. We need an overall rating for everyone to use. And I told him, I'm like, then I called him back and I said, hey, Bill, we've got this stock checkup that he loved, like when I showed it to him, but he never went out on the web. And that was on investors.com, and it was an overall rating. He's like, no, Mike, we need something for the newspaper. We can't put that in the newspaper. Why? I don't know. But there was a little disconnect. He's like, I need you to do an overall rating. I'm like, okay. So the stock checkup that I'd built that had an overall rating in there, I'd done it in this very complicated way, and it was solid, and I stand behind it. But I thought, okay, I approached it that way for this overall rating. Now he's asking me to build the same thing, but in a different way. And what was he after? He said, people are confused with the EPS is 99, but the RS is 13, and the SMR is, a C. What do I do? So I said, okay, let's get at the core of the problem. That's how I like to tackle something. It's like, what is your problem? Identify it and then fix it. So the problem was people were confused with all of these different ratings. So I said, let's just do an overall rating, just combine all of those things and then turn that into a relative number. And that was at the core of what I did there. So I put in the RS and the EPS, the SMR, the accumulation distribution, the industry group relative strength, which is the same thing as the rank, just in a different number. And then and knew it was missing something, and I'll circle back to what was missing that I ended up putting in there in a second, because that I improved recently. Then I'm like, okay, it's got all of this stuff, and I did them at all different weightings and things, and I said, you know what? At the core of everything that Bill ever did was the EPS and the RS. So I wanted to give them more weight. So I double weighted those and put everything in there, but it was still had this problem. I didn't want to put the RS3 in there, because at the time it was on no, actually the RS3 wasn't built at that time, I don't think. So we couldn't even go there. But even if it wasn't in the newspaper. So it was really tasked with what was in the newspaper that was confusing people, and put it into one number. So I put those all in there, and it still was missing something. And what was missing was the thing that we always look at, is how far off the high is a stock. Because a big part of the concept at IBD is that if you have a lot of overhead resistance, you've got to, let's say a stock was at $100 and now it's at $50. It's got to make it all the way back up to $100. And along the way, it's kind of hard to do, because everyone, as they get back to even, maybe they bought it at $75. Once it gets up there, they're like, oh, I'm finally even. I want to sell. So the off high is a big part of what we're doing. but it wasn't part of uh, this composite rating. So I said, you know what? Let me put that in there. And everything I converted to a 1 to 99 like the accumulation distribution wasn't a 1 to 99, but I converted it to it. And the EPS, RS, and the SMR already were in that state, as well as the industry group relative strength. So I said, I'll just do a 1 to 99 using the off high. So if it's 1% off its high or less, it'll get a 99. If it's 2% off, it'll get a 98, and so on. And I thought that was genius at the time, and we put it in, and I'll circle back to where it wasn't genius. And we put it in there, blended it together. So it's super simple. I'll just say it again. It was double weight the EPS and the RS, single weight all the other ones, industry group relative strength, accumulation distribution, SMR, and the off high. Put those all in a list and take the top 1% of those, get a composite of 99, then the next 1% of 98. And he loved that. He loved that rating so much, he stopped using his other overall rating, which is one of the ones that we were going to talk about in a little bit, which is that we're sunsetting the timeliness rating, because
Right.
the timeliness rating was just a letter grade to this data graph rating that we had on the WAN side, which was an overall rating. And he stopped using it because he loved my composite
And
rating so much. And for him, an 88 or higher was his kind of key threshold. He called me one day, he's like, Mike, don't you ever give me a stock that has a composite less than 88, and click. And it was funny and endearing.
love
And
it.
he was serious about it. And that was his
It's a good
thing. He would have
number.
a
Good
hard,
threshold.
say again?
So it's a good threshold. It's a good
It is
number.
a good for it. It really
Yeah.
is. I'm like, every time it's not 88, I'm like, better have something else special.
Yeah.
So over the years, it really bothered me because that was bad logic on my part. The 1 to 90, taking the off high, 1 to 99 that way, because within 0 to 15% off your high, so in that case, like an 85 or higher, those are all pretty much in the same ballpark. But once you start getting more than 25% off your high, you're really dealing with damaged goods, especially
Yeah.
50% off. And it wasn't hurting it enough. It wasn't hurting the rating enough. And also, when you got into times like '07 to '09, when everything was off their highs, that component was, most stocks were having like a 50 rating or lower. So it bothered me. So now that we got a chance to revisit everything, I said, you know what, let me do this. There's got to be a better way. So I thought about it. I'm like, okay, sometimes 12 months isn't the perfect look back. So I've got some other look back periods in there, to again, to have more data points and smooth it out. But I did it on a relative basis. So we have an off high rating. Eventually we'll roll that out. We have so much else going on right now that's not what we're going to release right now, but eventually we will. It'll be 1 to 99. That's a component of the composite that just on a relative basis with these different look back periods looks at all the stocks in the universe, so excluding the exclusions, and gives it a 1 to 99. And then that goes as part of the composite. So now the composite's even better, and I'm just super thrilled about that one. So I think we've tackled the EPS, the SMR, the composite. So now we've got to tackle the accumulation distribution. This was a tricky one, like super tricky. And I was so grateful that Justin made some time to work with me on this, and we were able to jointly do this one together. And two brains are better than one. And we were able to take the old, um, very complicated way that the accumulation distribution was calculated and just revamp it and think of it in new terms. And now we use, like behind the scenes, it's still price and volume. I know people would probably be concerned that because I don't use volume with my analysis. And I thought about it and I thought, you know what, it's very important, Bill's legacy that he left, and I wanted to keep it in line. If I was building just a Mike version, I would not include volume, but it's not. It's an IBD MarketSurge rating, and with that, volume had to be part of it. So it's a lower weight, but it's still a decent weight in there. And then we put the ATR in there because it's a big thing that I look at, and the closing range where the stock closes within its range is heavily weighted in there. Lots of other secret sauce. And then as soon as I get a chance to breathe, Jess and I are going to go in there and make this even better. But I'm really thrilled with where it stands right now. And then I think we talked about the relative strength ones. We basically the 3, the 6, and the 12. We just have the varying different things on there. So it
Yeah,
leaves us with
fine-tune them.
the industry groups, right?
Exactly. I do just want to quickly
Sure.
reiterate with the AD rating, that is not a relative rating. So everything, including the excluded stocks, will get the AD rating. And then I think the other thing to reiterate would be when you're running a custom screen, what will you see or what do you need to be aware of with this universe list and the updates to our ratings?
Perfect. So two separate questions there. For the accumulation distribution, it was always an absolute rating, so not relative, and so we kept it that way. We debated about making it a relative rating, but again, we wanted to keep things as close to the original concept as possible, and so it remains a an absolute rating, meaning it's just looking at the ETF or the stock itself. So we thought, why not let all stocks in ETFs have one? So in there, if you want to screen, you can use the accumulation distribution and anything, as long as it's traded enough, it has to get through its initial IPO time frame, get enough days in there. We're trying to make it shorter, but there's enough days that it has to trade, so it has the data to analyze. Because what is accumulation distribution trying to measure? It's trying to measure accumulation and distribution and give you a score, the higher the better, and that's what the formula is, going in there and saying, okay, given this price and volume, is that the stock under accumulation or not? And eventually, we hope to add that as a line up on top so people could visualize rather than just see, okay, it's a B rating. Well, a B rating coming up from a C is different than a B rating coming down from an A. So, on our future roadmap that we're going to talk about later, that's one of the things that we want to put in there. But so for the screening, you can do accumulation distribution and you would get the entire universe. For the relative strength ratings, those you can use for all ETFs, but they're compared against each other. And you can use it for any stocks in the universe. So if you want to do a screen and you want to include everything, even those really, you know, low market cap stocks that you probably don't want. But if for some reason you're doing some sort of study and you want to include those in there, just remove composite, um, SMR, EPS, um,
Yeah,
from
the
your thing. You can
proprietary ratings.
yeah, and
You
you
can
can
screen on other elements.
yes, you can put all the other things you can do, put off high in there, you can do volume, you can do sales, you can do margins, you can do any of the other things that we offer, just excluding the O's and as well as the relative strength, because you won't have a relative strength if it's not in the universe. So yeah, a very important question, Ali.
Great. Let's talk about the updates to our industry groups. And this was a group effort. Guess that makes sense. Industry groups, group effort here, led by our chief content officer, Chris Gessel. And I was able to really observe a little bit of how this came together. And we, rolled up our sleeves and tackled the industry groups and made some really great updates. Webby, why don't you give everyone an inside scoop of what we did, what changes that we made?
Sure. So this one was a real team project, and as you mentioned, our good buddy Chris Gessel was in charge of all of that, and I think he did a bang up job. He knew to task, because what we were doing is taking all the 197 industry groups and doing a major overhaul on them because it needed it. It was what people don't know. They always think, oh, there was something special about 197. There was nothing special. It was a limitation with our mainframes, and that's going back decades and decades ago. So there was nothing special there. So we just looked at it and said, okay, let's get rid of groups that need to be gotten rid of. Let's merge things where it makes sense and include new ones where it makes sense. So, and again, that was really a Chris thing. I think he did a great job. So we came up with the cryptocurrency is its sole one, THC for that product, because although it's not hot right now, a number of years ago, that was a really big area. We took other groups that were huge, like biotechs, and broke those up into three distinct groups: really profitable ones, not profitable ones, and then ones that are just in development stage. So because they are three distinct different types of things. And then we took utility stocks and we merged those. So just a lot of things that made logical sense. And
Yeah,
that's what's great working with the team. And you were involved. Justin was
a little
heavily
bit,
involved.
a little
Um,
bit.
Ed Carson was involved.
Yeah.
It was really a group effort where pretty much everyone on the staff was tasked with, oh, hey, here are these banks. Let's do it in a different way. Here's everyone kind of had their sector that they took ownership of, and I think they did a great job. So now, right now, it's 145. That will change. Maybe in a year from now, it's 150 or 140. We are just going to expand and contract as needed. Now, if you want to look at the old industry group charts, then we put that in MarketSurge, and we could probably show that in a little bit, just to see where people can look and see it. We're calling them the legacy charts. And we'll just keep those around because sometimes people want to go and study, oh, what happened in 2007 or 2005 or what have you. And we didn't want to get rid of that. But with this new group, and I'll talk about this in a second, that we're changing how we're doing everything with the groups. It didn't make sense to just have one chart that was calculated a certain way, and then this new chart with this new industry group name attached to it. So we just we did a fresh start, and we just were able to compile it back, I think about 9 months or so, with this new philosophy. So the new philosophy is something I came up with because the industry group charts that we had before weren't done. They were
In the
done in
best
a different
way.
way. They were done in a different way. They were price weighted because back in the mainframe days, that was the easiest way of doing things. You couldn't even do an equally weighted or a market cap weighted in an easy way back then. So it was just tally up the prices. Well, that's very problematic when you have some stocks in the group that are $1,000 and another one that's $10. And so if that $1,000 stock has a little bit of a move, it's going to have way more of an impact than the $10 stock going up 300%. That never made sense to me. So we had a choice. We could either do it equally weighted, which was one road, not a bad road, just a road to go down where the biggest stock in the group, let's say it's Apple, and then the smallest stock in that same group, whatever that one is, getting the same weight. It didn't make sense, but you can see a use case for it. It's kind of like using the RSP versus the SPY. It's a different way of looking at it. But what made the most sense was what everyone's used to: market cap. That's how the S&P is created. That's how IWM is created. That's how the Nasdaq Composite is created. The Qs. I thought, you know what? Don't reinvent the wheel. Just do it the right way. So it's market cap weighted. We have some limitations on some really small market caps that aren't part in there, but they wouldn't really have a material impact. So it's just all of them in there. So it's no longer price weighted. And we also had this thing that not all stocks were included in there before. So we cleaned all of that up. So it's all stocks in the group, market cap weighted. That goes into your industry group chart that you'll see. Now, the industry group ratings are created off of the chart. They always have, but I changed the way we're doing that. So again, we had that drop off problem before that was really material with the industry groups, where if you had a key stock, especially a high price stock in the group, have a big move one day, because our look back period was 6 months. Once that 6 month was up, you would see a material change in that rating, and it made no sense. So what we did was the same approach that I took with the normal RS, is smoothed it out with more look back periods, and just did it in a more gradual way. So you still have more weighting on the you have more weighting on the most recent action, but it's spread out over that 6 month time frame, and so it just makes a lot more sense. It's going to be smoother. You're not going to see these jump ups and big drops in there, and I think it's going to be a much better way of looking at industry groups. And frankly, I stopped looking at our industry group relative strength
Yeah,
and ranks because the
the
dirtiness of
logic.
the rating bothered me. Now I love it, and I can't wait to have it as part of my daily routine.
Yeah, the logic is logical. Who would
There
have
you
thought?
go. Yeah, there you go. And
Yeah,
I'm not sure if I said it before at the end, but that is part the group relative strength is part of the composite rating, the 1 to 99 version. If people don't know, the group rank, which used to be 1 to 197, that's the only one that we do kind of in reverse just to confuse people,
right.
keep people on their toes. 1 is the best, 197 was the worst. Now the 1 is the best and 145 is the worst. Probably someday maybe we'll change that. But it's the same, using the same underlying calculation as the relative strength. So I tend to think in a 1 to 99 mix is easier for me to think of than a 1 to 145, but use whatever works for you or use both of them.
Yeah, that's great. So we'll just show everyone where you can see this on the platform. So if you open up the bottom panel and then you go to reports, you will see the industry groups there. And once we roll out the new industry groups, the 197, those will be the legacy charts, as you mentioned, and those will no longer be updated. You mentioned that, just wanted to reiterate, but are available for historical study. So they are going to be two separate things. So you'll see the new groups with that. Oh, you said 9 month historical look back, and then that will be updated in real time for future use.
Exactly. And so the legacy ones, they will be static. So over time, those ones won't get updated because they're different. But still, if you're just curious, like, oh, what did the home builders do back in 2000 to 2002? You
Right.
can still do that. That was important to us because we want to make sure we
Yes.
kept that for, especially for our longtime Market Smith, Market or Daily Graph, online Daily Graph printed books. We have people that have been with us since way back then, and we really took that part seriously. And we wanted to make sure that we were making products for everybody, whether you're brand new to IBD and Market Surge, or you've been with us, since the '80s. And we just appreciate everyone being with us, and thank you for your patience while we're making these really exciting changes.
Yeah, we're just scratching the surface here with this video, Webby, and more to come on the future a little bit later on in the show. But yeah, I think this industry group project, really great logic that you came up with, Webby, and then the group changes themselves just a little bit more on that quickly is we were really able to leverage our newsroom expertise. If you think about it, we have these editors who know and reporters who know the ins and outs of all of these different industries. So they were really the perfect people to get their hands in there and make those shifts in the group. So I think that made a lot of sense, and the team did a really great job with that. So
Yeah,
excited to have that.
this was a massive group
Long
effort,
time.
and people put so much time and effort into it, and like you said, the right people, like the
The experts.
what yeah, what Chris did was so smart. He's like, "Okay, if you always write about medicals, then why don't you take medical groups? You always write about retail, why don't you take those?" And it's just a great job of splitting up work that would be too much for even 2 or 3 people to do, and so it was, I'm very proud of the team, and then, they also work with the folks over at Dow Jones that,
Mhm.
helped out in a material way too. So we're very, blessed to have, deep resources from the Dow Jones side helping us out with everything with this. We couldn't do it without them, so
Yeah.
we're grateful for that help.
Exactly. And I think the great thing too is when we do have new issues, we'll be able to stay on top of what group makes the most sense for those stocks to go into. So, all
Exactly.
right. Well, another very exciting update that we want to talk about today, all the updates to pattern recognition. So, this is another huge update and innovation on top of the original innovation here, Mike. So, once again, you're the perfect person for the job here. Why don't you tell everyone about these really exciting updates? Because I know as someone on IBD Live or our Stock Market Today video, sometimes I find myself drawing patterns that haven't been picked up by the pattern recognition logic. So, you can tell us more, but I think part of this is you set out to build more logic into some of the things that were getting overlooked on the charts.
Yeah, so just we'll start at the beginning with the pattern rec so for people to understand. I wanted to create this. I started working on this in the late 90s before I was working directly with Bill. I was at the organization, but it was before I was a portfolio manager for him and then, certainly before I was the director of research and development. And I ran into a brick wall because I'm not a programmer. And I tried getting some software and tried to learn how to code, and I couldn't. And so I had to shelf it for a while. And then someone at the firm came to me and said, you know what? Or the president of the firm came to me and said, well, this was just a little bit past 9/11, and there was all this talk about facial recognition. And she said, well, if we have people can do facial recognition, now everyone has facial recognition, but back in the day, it was kind of a newer thing. Said, if we've got that, I wonder if we could do things with charts. I'm like, yes, just give me a programmer. I've been wanting to do this and I ran into brick walls. And so I said, I don't need a good programmer. I just need a good mathematician because when you're dealing with this stuff, you kind of get into some nitty gritty high end math stuff. So I said, just give me a PhD math person that can code relatively well and just let me do this. And then, so about a decade later, I finished that and I went through a few different people that I was working with over the years. But the goal was, again, to save time and make you money. Was if we're looking through, if I'm looking through all these charts, I'm going to see the patterns, right? If I'm looking at 5,000 charts a day, it's not a problem for me to see everything. But if I want it quickly or a customer wants it quickly, that then you want to be able to bring all the patterns that you're seeing up to the surface. So eventually we'll get to screen off of these, but this is phase one. Eventually we'll get to screen off of these, but I wanted to have something on the chart where everyone could see, okay, this is a cup, this is a double bottom, this is a flat base. That was at the core part, but then it's really the bells and whistles because I got sick of counting bars. Like many times, whenever I'd give a name to Bill, he would, if it was on the borderline of how long it needed to be for a base, he would say, well, how many weeks is that? And so I got into the habit of counting bases, or how deep was it, or how much did it move up from one level to where it is now? I was like, this is such busy work. I bet you I could use pattern rec
Love it.
for all those bells and whistles. So if you already know what the chart looks like, you know what a cup looks like, a double bottom, you know it inside and out. So you don't need the computer to tell you that, but you want to be able to harness it and go, okay, is this a fourth stage base? And where exactly is the pivot? And just be able to hover on it and do that. And that's what I was able to accomplish with that. And over time, I would improve the pattern rec logic. At first, I didn't have my IPO base, which was a base that I invented, the only base in our family of bases that wasn't created or popularized by Bill. And so I put that in there. And the first pass, we didn't have ascending bases because they were super tricky to program, and didn't have double bottoms because they were super tricky to program. So I got those in there, and that's what everyone has been able to use for all this time. And it really saves you a lot of effort in counting things, or even knowing, like, there's this critical thing, or not critical, very important thing to know is, did a stock move up more than 20% out of its base within a certain period of time? Because that was a key Bill thing, was if a stock goes up 15 or 20% or more within 15 days or 3 weeks or less, that has, that's special, and we want to treat it as such. And so that's why we put flags in um, on MarketSurge in there showing, okay, this went up 27% in 3 weeks. You know, pay close attention to it. Doesn't mean it's going to work, but you just put it in a different category. So there were all those bells and whistles that I built on it, and I have a lot more that I want to put in there. But we needed to
Yeah.
kind of change the foundation because we were just switching platforms and everything, and so the code needed to be rewritten. So I worked with Praveen, here, who's a great programmer. I'm so grateful to work with him, and he had started trying to rebuild it before I came back. But then when I came back, I mean, when you're the person who built it the first time, so we I just been working with him and very happy with what we have for our phase one. And I'll show you some charts in a few minutes, but I kind of want to talk about some concepts that are different. So again, we're starting from the ground up, complete rewrite of the code, but with the same concepts was slightly different things in there. So one of the things was I had this um, secret sauce into where to start the base because to recognize a base, you've got to
Yep.
be able to know where to start it. And our eyes go and you can see exactly where to start it. And I knew how Bill would look at things. And so that's how I had worked it in the original code of like, okay, he didn't like bases that were low in a move. I mean, he was adamantly opposed to them. And so I tried to exclude those except in some rare cases. And so there was some secret sauce in there, but it would be confusing because sometimes it would show up, sometimes it wouldn't. I would know why, but no one else would know why. And it added a lot of confusion, but also a lot of missed bases, which the goal of it is not to draw something so Bill wouldn't have to do it because he didn't need it. It was to have something to help people save time and make money. So I said, you know what? Let's do it in a very easy way. The easiest way is okay, if it's hits a fresh high for 13 weeks or one quarter, we are going to go because that was part of the secret sauce, but not all of it, was let's start there. So now you'll it'll make a lot more sense once we look at the charts in a few minutes. But we're starting it whenever you have a 13-week high, that can qualify for base if it meets all of the other parameters. So that's one aspect that is different. Not better, not worse, just different. Then the other thing is we decided to go with the earliest pivot. With my old code, what I would do is pick, let's say it's a cup with handle. And sometimes with a cup with handle, you can have 3, 4, 5 qualifying handles along the way. Remember, a qualifying handle is the handle is in the upper half of the base structure. So if the program is going in there and picking out and saying, okay, this is a cup, which handle is the right one? In the old one, it would go and say, okay, well, it broke out of that one, but now this is a better looking handle and a better looking cup. So we're going to switch it to that one. There's a use case for that. But we really thought switching it does confuse people. And really what you want is kind of that earliest one. So now the earliest qualifying handle will appear and it will stay there. It won't keep redrawing it. And that, I think, with the consistency of that, and people, once they understand that, will be able to see like, okay, here was the cup with handle that broke out at, $23. Now it went up a little bit further and now it formed another one at $26, but it's still showing that it broke out from that other one. So it's kind of the best of both worlds again, because you'll see that the pattern was there. You'll see that, okay, now it's X% extended in X number of days or weeks from that last one. So you'll still have it there, but it's going to be the earliest one. And that was kind of the approach with all of the different bases, but there's still the same base types, the flat bases and the consolidations and the double bottoms and the ascending bases and so on through there. But this is certainly a phase one. There are things that we weren't able to accomplish, but it's good enough more than good enough to release. But I'm going to be working on this, for the coming years, and work with Praveen, and we will get, hopefully every 6 months to a year is kind of my target to roll out some improvements on there, and I know exactly what I want to do with those, and just make it better and better. And how I measure better is the same way I've always done it with Pattern Rec. I would always take 100 random stocks, and this would be over that decade when I built the original one, and I'm doing it again. Every week or so, I would look at 100 random stocks, look at the most recent base, and say, is this the lens that I'm seeing it through? Is the computer seeing it through there? So if I'm seeing it as a cup with handle, is the computer saying it's a double bottom? And then I would say, okay, then I failed at that one. And then I would go through, and anyone can build a pattern rec to get about 50% accurate, like right out of the box. If you understand how to code and you have a coder or you understand the logic to tell the coder or ask the coder to do, you can get to about 50% very easy. But then there's this teeter totter. As you get from 50 to even 51%, you improve one thing and
fifty-one
you
and a
hurt the other.
half
Say again?
percent or
Or
51.5%.
51. I was like, oh, I'm gonna leave that one alone. Yeah, and then you get to 51.5. That was a tricky one, Allie. So if you get up there, then you hurt these other things. And so making major improvements from there is really tricky and takes a lot of time. And that's why the first go around took me a decade. But since I already had that knowledge, we were able to do this in a relatively short period of time because I've been back at IBD for about a little over 2 years now, and we didn't start right away. So we were able to accomplish a lot in a short period of time. And when as we go through some charts, I think the other examples will pop up naturally. So why don't we do that now, and then I'll talk through what we're seeing. So what we have here is both on there. This is just a temporary tool that we were using in-house to identify what was the new pattern rec and what was the old pattern rec. So the new pattern rec on here you'll see is orange. The old pattern rec, the way that everyone has been seeing it, shows up in green. And if they are matching, it'll show up in that teal kind of blue shaded area. So let's just start from the right side of the chart and go backwards. So the most recent one, our new pattern is saying that that is a cup, whereas the old way would have said that um, that is a consolidation or a flat base in there. And they're both still giving the same pivot. So this one was an improvement. And what I was saying before about, as I would look at 100 stocks, so I would look at this and say, okay, this is a yes. It's the new way is doing it the way that I want it to do it. And so I would do that every day or every week, as I was building this the first time and this time, and just say, okay, what percent out of 100 stocks am I at? And that would be my grade to myself of where we got. And the old one, the original version, I was able to get it to be 80% accurate to my eyes. And that was a big task. Like in the last 75 to 80 took forever. This go round, I was shocked. I didn't think I was going to get it past 60 or 65%. I got it back up to 80, but just a different 80. So I fixed some problems, created some other problems, but still at the same caliber as it was before, but with these improvements that make it, I think, easier to understand where the patterns are. So I'm looking at this as a major improvement, even for just a phase one of this. So very
Yeah,
proud of what we were able to
great
accomplish.
job.
So let's look at what's going on there. So that most recent base, we're doing it same pivot, but we're saying it's a cup. They're saying or my old thing was saying it's flat base. Okay, that's fine. The one before it, this is where it's important. That cup with handle that's in yellow or orange, that wasn't showing up before because of the logic that I had to pick that high. You can look at it as a cup with handle clear as day, and that used to bother me so much because it wasn't picking it up. And what you were saying, you do on IBD Live, you'll draw them out because for one reason or another, it slips through that 20% that isn't accurate. So this one is able to pick that up because that left side high is a 13-week high. So it was able to pick that up with the new logic. The base before that, that's in teal, they're both the same. So yeah, most of them are the same. The one before that, the old logic had as a double bottom. The new one, or there's an ascending base, is kind of hard to see in there, but in that leans off of the daily logic, not the weekly logic for this. That's a can of worms we don't need to get into here, but we could always in the future. But the one before that was a double bottom. This is something that I want people to know that for phase one, I wasn't able to link the dailies and the weeklies, which is an important part of pattern rec, where when you look at a weekly, you have 1 point for every 5 points you have on the daily and vice versa. So behind the scenes, when you look at a weekly pattern, you also want to look at a daily. And when you're looking at a daily, you also want the computer to look at a weekly and run the algorithm through both. We weren't able to get that to where I wanted to go for phase one. So the one thing that you won't see are short double bottoms, because a short double bottom, the way the logic works is you really need a lot of data points in there. So if it's a double bottom on a weekly that's less than 13 weeks, it's not going to show up for phase one, 13 weeks or shorter. but you'll see it on the daily if it passes through there. And that's going to be the first thing that we do for phase two. So that's why I wanted to show that one where one or the old version has it as a double bottom. This one has it as a consolidation. You'll still see bases there. It's just, it'll be different. The prior three bases were the same. You go over to the left side of there in June and September of 21, where, and this was a big problem that I had
Yeah.
in my old code, was you could see a big long consolidation. I used to call it my Microsoft problem. Everyone that would hear it thought it was software. It's like, no, in the 90s, there was this time where Microsoft formed base after base next to each other. And I could never get my code to, because just the way I was approaching the left side high of it, I couldn't get it to work properly. So it just put this whole thing into a consolidation, even though there was clearly cup next to cup next to cup. And it bothered me. Like, it really bothered me a lot. And so we made major improvement there. And this is an example where the old code just shows that whole thing as a consolidation, whereas the new code shows the cup with handle that tries to break out, doesn't go anywhere, then goes into a little flat base next to it. So that was that pattern. Now, if you go over to the left of it, is picking up that one the same. And the one before is a good example of what I was talking about before with where we're both picking it up as a cup with handle, but the new version will always pick up the earlier one. So I think that's pretty much all the ones on that one that we need to tackle. Does that all make sense?
Yes, and I'm really excited about all of these updates. It's gonna be
Me,
so
me
helpful
too.
for
I'm
everyone.
I'm thrilled that I mean this was a big, as you know,
Yeah,
like I had to stop going on IBD Live 3 times a week, stop doing the IBD
very
Live watch
complex.
list to work on this stuff. So let's look at the next chart and show some more differences. So this is a good example, and these are, we do have the best fit on there just so everyone can see the charts better. So these are stretched out more than you would see with the standard fit, but for this purpose, it was needed. And you can see that in green there, the old code would have that whole thing as a big giant cup because it was, and that's fine. There's nothing wrong with that. With this new one, we're seeing two patterns in there. We're seeing a little cup with handle, and then next to it, a little cup without handle within that pattern. So there's not a right or a wrong. It's just different. And maybe, in a phase four or something, or after, we might layer them on, which is something I've always wanted to do, but I know it would have to be kind of an advanced level because it could confuse a lot of people. It could confuse a lot of people if you did that out the gate. But the cup with handle before that, you can see another example of the one in green just has a little bit of a higher handle. Ours is the new one is a little bit earlier. They're both right. They're both valid. We're just going with the earlier one. The base before that happened to be a flat base, or happened to be a cup on the old version, a cup with handle on the new version. Why don't we go on to the next chart and see? So this is Johnson and Johnson, and it's stretched out, so that's why it looks like it's a wild and crazy stock, but it isn't. But this was a good example of showing the bases, the new bases that you're going to see that you wouldn't have seen in the past. So the ones on the right, the two teal ones, that's the old version and new version doing it the same way. All those prior bases, you see the only orange on there because that's the new code getting it in there because of the new logic with how we do the 13-week high. And I will say on there that it's a 13-week high, or it's it has already broken out of a base. So it can break out of a base or have a 13-week high, and the highest point after the breakout can qualify for a high as well. Why don't we go to the next one? So just another example of how the cup with handle is just earlier. If you look at the one on the far right side, but look at all of those other bases: 1, 2, 3, 4, 5, 6, 7, 8, 9 other bases before that. Where the code is picking up with all brand new logic, like a new code picking it up the same way. So I'm just very, very happy about that. And you can see the base before that, the cup with handle. Again, it's just picking the earlier one. And I think as long as people know that, they'll be able to understand. Sometimes it'll be in the lower what visually looks like the lower half, but it's not. So just so folks understand how to measure a proper handle, you take the high of the base, the low of the base, you just take that average. Let's say that average is $50. If then you do the same thing for the handle, you take the high of the handle, the low of the handle, that the average of that just has to be higher than that 50. Even if it's 50 and 1 penny, that's in the upper half. That was something that was blessed by Bill to do. Now there are exceptions when they're in the lower half, but you'll have to use your eyes for that because that was something that he was really opposed to. And I wanted to stay within the his philosophy, even though there were times where you can have a lower handle that he would agree with, he normally wouldn't. And so it was very important to me to stay within the same lens that Bill would look at things. With that, we kept the part that he was adamant on a double bottom, that the second bottom has to undercut the first bottom. We kept that in there. All the things that were really important from a Bill standpoint, I did not want to deviate from because I've always looked at this as my way of, having something that how would Bill's eyes see it? And that's how I would always look at this is I know how I look at things, but I also know how he would look at things. And it was always trying to get his eyesight through these charts. So why don't we look at one more?
Here we go.
Okay.
This is another good example.
Yeah, it is a great example because you can see how up on the top right, the old code had it as a double bottom, which it is, but the new code has it as a cup with handle next to a cup, which it is. So always there's always an art to reading charts. And back when I used to teach the chart school with Charles Harris, a good friend of the show and everything, a former colleague and a PM over there at O'Neill, that we would always talk about how we could both look at the same chart at the same time, but look at it in different ways. And Bill would agree that we were both right because there wasn't with an art, there's not a right or a wrong. And so as long as you're within the realm of what makes sense, there's not a right or wrong. To call that an ascending base would be dead wrong, but that's not what we're doing. So the old version had is a double bottom. We break it up into two smaller bases. And so I think the new way just gives you more entry points and earlier entry points as a general rule. Not always the case, but in most cases. The base before that, the cup with handle, another example of the earlier handle. And then the base before that, we're picking it up as a cup with handle, whereas the old version was a flat base in there. And you can just see that throughout the whole thing. What's interesting is if you put your eyes to kind of the May to September of 22, the old one had this giant cup with handle, which was right. But then also within there, it was able to pick up, the new version was able to pick up this little flat base. In the end, the pivot is the same price, but you're just looking at it differently because the code looks at the whole thing and says, okay, what do you have? And at that point, it must not have been passing my cup logic. So it doesn't want to look at the full consolidation if it can help it. Could it find something smaller in there? And that's where it found the flat base. And to the left of that, you can see all the patterns were matching. Do we have any more charts?
We do.
Okay, let's look at them. Okay, so another example, these will be quicker. Another example where a large cup with the old version in green, the new one is just smaller, and this gives you a real nice earlier entry. The prior base, you can just see we picked it up as a cup where the old version had it as a flat base or a consolidation. You're going to see that a lot where, sometimes with the new code, it's clearly a cup, but it's going to show up as a flat base or consolidation. And we will continue working on those because, again, we have 20% of them that I really want to improve on. But that last 20%, each percent is going to be a lot of work to get it better. Let's go to the next chart. So this was a great example. If you focus your eyes on the most recent double bottom here, where the old code wouldn't pick up anything there, but because that's a 13-week high, we're able to get a pattern on there and, give you an entry point. It doesn't mean you have to take it. Just because this is an important thing with pattern rec that I don't think anyone ever truly grasped. Just because the computer picks it up and says it's a cup, or your eyes say it's a cup. Let's say the pattern rec doesn't get it at all for whatever reason. It doesn't mean it's going to work. It's just what it does is it gives you an entry point and a place to manage your risk off of it. All cups don't work. All double bottoms don't work. That's not what you're after. What you're after is getting in at a logical place where you can manage your risk. And that's why patterns are so important. Now, then on top of that, you can have all the bells and whistles, like you can see up in the top right-hand corner that we show that it's up 28% within 18 weeks. So that was one of my favorite things to add, because then I didn't have to count bars when I was talking to Bill, because he'd say, "Oh, how far is that out of there?" And you have to count bar by bar, and that gets old real fast. And so those types of things, or do you see that little 22% in there that was showing that out of that base, it went up 22% within 3 weeks, to just alert you, say, okay, this was unique, pay attention. Doesn't mean they're all going to work, because they don't, but this is a way, again, to save you time and hopefully help you make money or manage your risk. Why don't we look at the next one? Okay, so just, another example of some differences where this one has two patterns on the right side, a cup with handle and then a cup without handle, versus the old version, it has a big cup with handle. Both are right, just different. And this one gives you two entries, whereas the other one gave you one. And then you can see in the middle there some other bases that my old logic wasn't picking up. But now with the 13-week high, it's very easy to say, okay, it's a 13-week high. Does it recognize anything there? If it does, then it'll go ahead and mark it.
Last example.
Perfect. So you can see on this one, the most recent base was picked up by both. That's why it's in teal. But if you go down to the middle of the chart, you can see that the old version had it as a double bottom, very clearly a clear, classic looking double bottom. But also on the right side, it happened to be a cup without handle. And so it was marking it up that way. And both of them have that power from pivot, that 85%, showing you that it went up 85% within 3 weeks. Pay attention and you see what ended up happening there. So that's why I kind of wanted to highlight this, because if I was drawing this one by hand, I would draw that as a double bottom, not as a cup. But both are right. They're both accurate, and I'm just really proud of what we were able to get accomplished. I didn't think we were going to be able to pull this off. I was very, very, very nervous because we had some deadlines that we wanted to hit. And I'm just very proud that we were able to accomplish this. And we're going to just make it better. We're not stopping. We're not slowing down. We're immediately going into phase two. Right now, we're just cleaning up some bugs in there, but all the logic is down. We're just making sure that the computer is doing what it's supposed to do. That's what we're focusing on for the next couple of weeks before this rolls out to folks.
That's amazing. Just a couple quick things. So speaking of what could be in the pipeline, we'll be very brief about this, but I'm seeing a stock on here that has doubled. It's up 100%. So maybe other patterns that
I
we
see where
could
you're going with that. Yes.
detect coming
So
down the pike
yeah.
eventually.
So for phase two and phase three, I'm going to be improving the code, but I'm also going to be um, focus on new patterns. So in the past, I had built some things that I never released. So I built high tide flags. I built climax tops, which was more complicated than you would think, as well as upper channel lines. And so I'm going to go and rebuild those as time permits and get those out there for folks. And so I'm very excited about having that, plus some other bells and whistles on there that I want to do. So this isn't going to be right away, but just letting people know what my focus is getting alternative pivots. My very, very, very first version of, and we don't have to look at the chart anymore. That my very first version, I had alternative pivots. What's an alternative pivot? There's a few different ones. There's a downtrend from the left side high of a cup to tangent with the top of the handle. That's one. Bill liked that one a lot. There's a downtrend within the handle, which is my go-to, that if you have a handle and a cup with handle, you can draw a downtrend through there. That's my go-to. Bill was more of a prior resistance type of person, so within that same handle, if there was an area where it ran up to and then backed away, that became an area of resistance. So I built that in my very, very first version 15, 20 years ago, but then removed it because it was confusing to some folks. And so, and it's very hard to do it right. So that will be in future phases. And there plus a bunch of other things that I want to build in there to help you do what, Allie? What's our goal?
Make more money and save time.
There you go. And so that's what the lens, as I go through pattern rec and add things on there, they're all going to be in things like that, like the little webby shelf that I've invented
Yeah.
and anything that my eyes are seeing, I want to be able to put in there for that reason of saving people time, saving me time, frankly. On
Yeah.
a selfish level, I love using this every day. And ever since I built it,
Right.
I've used it because it saves me time and hopefully is helping me make more money along the way.
Well, that's all very, very exciting because I could even see how maybe then some of these patterns, one could envision how that's flowing through into screening potentially and all sorts of exciting stuff. So,
Yes, and I had built this screening on the other side before, on the institutional side, so that is something that we want to bring to MarketSurge, in the future because it's very simple, like, okay, I wanna look at all cups with handles, or I wanna look at all cups with handles between, 15 to 25% deep with these characteristics. And that's you have to build a foundation first to be able to do all of that stuff. And so now that we've rebuilt the foundation on our new platform with our intellectual property, that we're able to build that in there and all sorts of things can be, we can put in there. In the past, I've built a base score. So I did this big study that looked at all bases from 1963 to 2013, looked at all the underlying data in there and then built a score using that at 1 to 99. So that would be in the future that if we rebuilt, because if you build it, you got to build it off of the platform you're using. So now that it's new code, I'd have to redo that study, which I'd love to do, see all the items in there that are important, and then build something off there. One thing that I talk about often, that maybe somebody hasn't heard from that study, I found that actually later stage bases had a higher probability of success than earlier stage bases, which was completely contrary to everything that we taught and how I thought. Because Bill would always say you want a first and a second stage base, want to avoid third and fourth stage bases. And that made sense. But then when I looked at the data, it was different. And I double and triple checked it because I was like, wow, this is not, I was blown away from that. And it would turned out the later stage ones had a higher success rate. Now, keep in mind the later stage ones have a lower sample size, right? Because you've got a ton of first stage bases, not as many second stage bases because they actually have to break out, run up 20% to get to a second stage, and then do the same thing, run up 20% from there to get to a third stage. So it's hard work to get up there to a 6 or a 7 stage base, but the few that get up there are up there for a reason, and they actually had a higher success rate. So that changed my way of looking at everything when you do original research. So the end goal is to be able to do that with patterns, also be able to do precedent analysis searches of saying, okay, I I'm identifying, or the computer identified this base on Qualcomm in 1999, and it ended up going up 2,200% in a blink of an eye. Find me all the other bases that look like that same setup using these parameters. So that's an end goal that, I'd like to have. So I don't want people calling up and saying, oh, to Scott's team, like, oh, when is that out? It's going to be a while because we've got work to do, but just want to let people know where my vision is going. And
yes.
again, the end goal is just to save people time. That would save people time. If you can find a precedent that works, that's going to make you money too. So it's those dual purposes that all of this stuff, that's at the foundation of whenever you build something, what is your purpose and the dual purpose for all of these things.
Exactly. So exciting. So, a couple more things before we go, including Webby's explanation of a few things that we have already launched in our new market surge charts. And the first of which is our quarterly fundamentals across the bottom on the weekly, the EPS and sales table. This is a huge release too that I know that you've been really happy about, this institutional quality visualization for the retail trading community. Why don't you talk a little bit more
Yeah,
about it?
I this is my favorite thing that we added because the
So
market
far,
surge, yeah, so far. The market surge revamp was a group effort where there are lots of people putting in, oh, I want to add this, I want to add that, and so it was really a group thing that was going on, and so some of my contributions are, I really wanted this along the bottom, which is unusual for everyone who's been using daily graphs or daily graphs online or MarketSmith or Market Surge because they're used to seeing it in a different format. This is a format that I've always used because I was using the institutional products that we had at William O'Neill that were based off of what Bill's original charts from before I was born, where he created this, where it would be a weekly chart was what he would go off of, do an earnings line, that green line that's on there showing, plotting out the earnings. But then along the bottom, it was very important for him to visually place it
with
this
the
way
action.
horizontally instead of vertically, because then it could line up with, you could see, okay, in the June 24 quarter, this is what the number was, and this is what the stock was doing. Whereas if you see it on the left side, the way we used to have it, there's a disconnect. Now we did that, at the time it was kind of, I always called it kind of the Toyota Lexus type of thing, where Lexus was the institutional side, and IBD Market Surge was, the Toyota side. Both really good vehicles, but just you had to have the separation thing. So we couldn't really venture into the institutional type of quality because then that would step on their toes. Fair, right? So you have a separation in your product, just like Market Surge charts are better than IBD charts, because it's a different product. Makes a lot of sense. So now that we are a separate organization underneath Dow Jones and News Corp, and we have deep pockets that we can help us build things out, we really want to build an institutional product that is for the retail public, and institutional clients are welcome to use it as well. And this was one of the first steps in there of placing it down there. So my goal is to continue, because that's what I used to do for part of my time at William O'Neill, when I was director of research and development, is building out things for our institutional products. So I've got all those that were on my to-do list that I never got a chance to do, that I want to put in our product and
Amazing.
really make it an institutional quality product, for everybody. And this was the first major thing. So what are you seeing along the bottom? You're seeing the quarterly information, you're seeing the EPS numbers, you're seeing the year over year numbers, you're seeing the sales numbers, as well as the year over year on a quarterly basis. That's at the core of the O'Neill, or that the way Bill would look at it, and the IBD methodology of the quarterly numbers, seeing is there acceleration, is there deceleration. And then could we go to the right side of it? Because I think this is very
Yeah.
important.
And I love how you
Now,
can pan and zoom on these
oh, right?
charts.
There was
That's incredible.
such a nice improvement on there. Then along the bottom there, once you see that thick black line to the right of that, those are estimates. So that's just showing you, the consensus estimates. What's nice now is because we're switching over data providers. So instead of going to what we had from Juan's data, we are now going to FactSet, which is kind of an industry standard, and not better, not worse, just different. And with an industry standard, what's nice is you'll have apples to apples, because in the past we would have estimates that were oranges to actuals, what's already happened. There were apples. So apples and oranges don't really go well together. You want apples to apples. So now using FactSet for our data provider, then those numbers of the estimates are going to be comparable to the actuals or what's already happened. So when you look at those numbers, they make a lot more sense. Most of the time, they were always the same, but occasionally companies would, back out charges in different ways. And so what FactSet does is they just go, okay, what do most of the analysts do for this stock or this particular industry group? And we'll do it that way, whether it's GAAP or non-GAAP. And so it's just kind of the way everyone else looks at it. And it also helps people because most people don't just use our product. They might use our stuff and see some other stuff online somewhere. And then it's like, wait, our stuff says it was 82%, but this other thing says it's 79%. Which one is right? And it'll help reduce the confusion there. So that's one thing that we already have in there. What I want to do for the future is on that green line there is to include that and put that as a dashed line going forward, including the estimate. So that would be something that we'll have in the future releases.
Mhm.
No date attached to that yet, but that's what we want to do, as well as adding that earnings line on the monthly chart as well, because right now it's just on the weekly, but we would
Mhm.
like it on the monthly because that gives you a different perspective. And we'll also do some different ways of doing the earnings line. And we'll get into that whenever that comes out. But there's, putting the sales line on there too will be something nice. We have this long laundry list that we've all wanted to do. In fact,
Yeah.
in 1998, I sent an email to folks at work saying that I wanted candlesticks in our charts. And so can you click on the candlesticks? Because it took a long
Yes,
time.
we
It's a long
have
time since
them.
1998. Now we finally have them. And one of the reasons is back then we didn't store open data. So for a candlestick, you need to open as well as a close and a high and a low. So we didn't even have it. There wasn't even technically capable of doing it. But now we've got a different data provider and we do have the open, high, low, and close. And so it allows us to do things like candles and you don't have to use them. I toggle them back and forth because there's a use case for having them and a use case for doing it the standard way. One's not right, one's not wrong. They're just different, which is the case for so many of these things.
Exactly. So that's huge. We also talked about the panning and the zooming, which I think is really helpful if you're doing historical looks on the different time frames. We of course here love typing in dates because for precedent analysis, I think that's huge too. But it is very handy for post analysis, I think, and a variety of situations to be able to scroll back and forth and zoom in and out on the different time frames. And then we also really love this inclusion at the top of every chart, the 21-day ATR percent. And that also has your fingerprints all over it, Webby.
Yeah, so when I came back to IBD a couple years ago, while I was away, one of the main things that I kind of shifted to was the average true range. Just like a couple decades ago, I'd switched from share volume to dollar volume, and then eventually everyone else kind of started looking at it that way too. So we've got the dollar volume in there, which is the amount of money that flows through on a daily basis. So think of it this way: if a stock, and we always look at things of a 50-day rolling time frame when we look at a volume. So we look at share volume over 50 days. Well, that's to me is just kind of silly because again, a $10 stock trading 100,000 shares a day versus $1,000 stock trading that, or let's say a million shares a day, completely different amounts of liquidity in there. And even though I don't use volume for my analysis, I heavily lean on volume for liquidity purposes, and dollar volume is the right way to do it. Share volume is irrelevant in, in my book. But with that said, I had this conversation with Bill back in the day. He was adamant, he was still old school, and he wanted 400,000 share volume or higher. So I just put that out there because that was what the man had to say. But I think given enough time, he would have shifted over to dollar volume. So we placed that up there. So it's very easy because before it was kind of some work to figure out what the ATR was. We want to just place that there as well. So that what is an ATR if you're not used to it? It's an average true range. And I like looking back 21 days. So we went with 21 days. Many times people would look at an average true range in a dollar terms. That's how we had it until I came back was it was in dollar terms, which is silly and irrelevant because how many dollars it moves doesn't make any sense.
Not
It's
apples to
what
apples.
it's not. It's apples to kumquats, frankly. So it is, so we do it on a percentage basis. So then you can get a sense for, okay, how volatile has this stock been? It doesn't mean it's going to continue. That volatility could expand or contract afterwards, but then right away, okay, you're looking at NVIDIA and the average true range is 3.03%, meaning of the last 21 days, it has traveled a distance of 3.03% on average. If there's a gap involved, it'll look at and include the gap. So it's the true range, which includes the prior day's close if that's outside of that day's range. And it really, oh, perfect. The AAOI, 13.72. So that's telling you are playing with fire if you're buying that, because if you like to cut your losses, let's say at 3 to 7%, well, this thing travels on a normal basis almost 14%. So you're going to have to be very precise with your entry points. Otherwise, you're going to get chopped up. And so that's why we wanted to show it to you, because if you just pulled up the chart, pull up Johnson & Johnson, because that was one that we were looking at earlier.
I'll go to
And
the daily
look at
here.
one point, and let's put it to let's go to the weekly and go to a standard fit.
Sure.
And yeah, can we do the reset button? Show them the classic Coke button.
Yeah.
So if you ever, before you do that, let's cancel that out for a second. If you expand and contract your charts, which everyone should, and play with that, sometimes you'll get it where the scaling we're going to work on that in the future, but the scaling when you stretch it out sometimes doesn't look the way it should. So we just wanted to have one button in there that I refer to as a classic Coke, that you just want to, for the young folks, you don't know what I'm talking about. Back in the day, there was a new Coke that came out, and then there was classic Coke. And some people loved the new Coke, but some people just wanted the old classic Coke. And so it was this big debate that happened. And so then they just had both of them there. So if you want it the old school way, just go up to the classic Coke button, which we call reset to default, because we'd probably have some problems using Coca-Cola. So let's click that, and then you see what ends up happening to the chart.
And we are looking at, like Webby said, fine tuning this and making sure that all of your custom moving averages and your different settings, like if you have lines that are a little thicker, all of that stays intact. But it's really that scaling that you're talking about, that classic view that we want to quote unquote reset to the classic Coke.
Yeah. So you know what? We don't even. Yeah. So now when you hit the button, now the chart looks right again, and they're actively working on all the bugs and things, and so everyone is every few weeks or so we're going to see some improvements when things aren't working exactly the way we wanted them to. But this part is when you hit that button, it puts it back to the chart that we all know and love, and we were really careful to make sure that we kept the same scaling look, because that was the gold of what Bill was able to leave all of us with, is how to look at a chart right. And in the scaling, there's so much more that goes into it than people would think. And so we were able to get that the same way that our old legacy charts looked. And there's always room for improvement, and we will improve on things, but this is really at a solid place right now. But let's go to the daily chart now that we've refresh that. So with this, you can see again that even though it's had a big move up there, that average true range is only 1.75%. So it really helps you to know the merchandise that you're trading. Now, the other thing that we added, because that we put the moving averages on the relative strength line. That's something that I came up with a couple decades ago and put on our institutional side of our products, that over the last few years we brought back to, or we put in MarketSurge, which I'm thrilled about, and that's at the core of a way of holding rules that I have around the RS line and those moving averages. But one thing that I'll let people know now for the first time is that I have The rules are quick, quicksand, Grateful Dead. Anyone who knows that knows that I'm using 2 moving averages. Why was I using 2 moving averages? Because I didn't have access to a third one. So with that in mind, go and show them where they can change and add a third one on there and even a fourth
Yeah.
one.
There's a couple of ways to edit the settings. So you can right click on the RS line and you can add more. So that's how you can add more just like that. You can set the period, you can change the color, you can change the thickness, and that is how you can do that. Really
Yeah.
exciting to
So
see.
yeah, super excited. So in the future, because I'm working on it now, I will have changes to my quick quicksand Grateful Dead rules, which will use a third line in there. But stay tuned for that. But that will be, I don't think I'm going to use a fourth line, but I wanted to have at least a fourth line because you never know. Because I started off with two and I didn't realize I was going to need a third one. But that'll be something for the future. But I just so people know, I do use the exponential of it at this point because that's what our old one was pointing to, even though it was saying simple, it was actually pointing to exponential. So if you wanted the same setting as what it was in legacy, just use the exponential. And so it's all there for you. And that was a very important thing that I wanted to make sure that we got in there. And you never know. I designed that for a problem that I had with Bill was when we were pressed for time to add stocks to the list because we were both trading. He was managing 4 companies, and I was, managing projects as well as trading money for him. And then at the same time, trying to decide what names we're going to put on the list. You had to do things very quickly. So I was always trying to build things to help us speed up the time, the time from, hey, we need to add more stocks in the chip space to which stocks are we going to add in the chip space. And using the RS line moving averages is what I designed for that and had no idea that it was going to morph into what I think is probably the best thing that I've come up with, which are those rules around it. And we've got videos and stuff on that. And we talk about it on IBD Live all the time. So tune in for that. And so just more bells and whistles that we're going to keep putting in on Market Surge. And the whole team has tons of ideas that they want in there. And of course, from you guys, we hear you. You're saying, "Hey, I love the new stuff, but could you add this?" Yes, we're building a big list and we're looking at it, and the group is looking at it and just deciding, okay, we're going to do these things first. Maybe they're easier to get in, or sometimes the best ideas take a ton of time. So maybe you can get 5 of the other ideas in there versus the one. That's our work to try to figure out. But just this is the first of hopefully many, many years of improvements with the Market Surge platform. And we're just all super proud of it.
Exactly. And just to underscore that, that's the whole reason why we changed platforms was to allow us to more easily add all of these bells and whistles. We were really constrained with the prior software platform. It was incredibly difficult to even get something simple out there. And so we're laying the foundation here, as Webby said, and there's so many exciting things. I can't believe all of the golden nuggets and things that you discussed today. The possibilities seem endless with where this is going. And thanks to you and you steering the ship here, Webby, I know that there are so many great things to come. That I mean, this audience is very lucky to have you building and creating all of these very, very helpful tools for everyone. So it's just, I can't say it enough how lucky we are.
Well, thank you. It's a privilege to be back here. IBD and Market Surge is very near and dear to my heart, and with Bill passing away when he did, I really wanted to come back, and because I thought I knew exactly what he would be doing if he were here and involved with stuff because we did so much of this type of work together, a lot of stuff that folks might not know, and it's fine. But I knew how he thought, I knew how he liked to design and build products, and everything. And so I'm just grateful to be able to be part of it. And it's really important to me for us to get this as good as we can possibly get. So, all the bugs will work out. And, it happens with anything. Microsoft launches something new, you're going to have bugs. Everyone, it just comes with new software. Know that sometimes there's a little muscle memory of, oh, I used to click up here for this item. Now I got to click over here. It takes a little bit of time to get used to. It's going to take time for me too, and for Ali and everyone on the team. So we're going through that learning curve. But like you were saying, we had to make this major change to be able to build. This was really a foundational level type of change we had to make, because think of it this way, like an old house that, maybe it was just a mom and pop together, and then they all of a sudden they have a kid or two, and they've got to build onto that, and they do an add-on rather than moving. And then before you know it, the grandkids are moving in with them, and they've added on, another story and 5 other rooms, and the foundation just doesn't match the house. And so at some point you kind of have to tear it down and rebuild it from the ground up. And that's what we've done across the board with everything. I'm just very proud of the team. So many people were involved with this, from, Scott's team at MarketSurge, as well as, Chris Gessel and you and Justin. I've just can't say enough about Justin from the rating side of stuff, because I would come up with the logic, and then he would be tasked with doing the hard work of typing up the documents and giving it to the programmers and working with them, to make sure that it's working, and checking to make sure that the old version versus the new version. And you just can't get anything done without somebody like of his caliber, and the programmers that we're working with, some of them are, just really, really special. And I just want to give a shout out to Praveen, who's we couldn't have done this without, and the newspaper could never get out without him. And so many people involved, and it's just a great team. And I'm just happy to be part of it.
Well, we couldn't have done it without you. So major kudos to all of your hard work. You should celebrate, but I know the work continues, right? Like you said, this is phase 1. We have so much in store that we're so excited about. You have an idea list that's a mile long, and things that, it's almost like
It's a
you have
country
this,
mile long,
this
actually.
country mile. You have this treasure chest of all of these jewels, just waiting to be dusted off and brought to life in the new platform. So, wow, that's just really special. One thing that I would love to finish on, for you to leave the audience with, is the fact that your mindset, all of the history that you have with Bill, and your experience as an amazing trader, on top of being an incredible builder, the things that you are hoping to build for this community, and just how special that is.
Well, you want more items that I can give you? Are you sure?
I mean,
So the list is so long, but some of the things I'm most excited about, they always go back to the concept of, is it going to save me time, and is it going to hopefully make me money? So I've got all these indicators that I've built, that when you and I, every Friday, that when we do the stock market today video, I show all these things, and we have to go out on other platforms, which kills us, right? Because we want to show it on MarketSurge. So my Webby RSI, we're going to bring that over. The Bob Marley off high indicator, we're going to bring that over. The regression stuff, the way I like to do it, we're going to bring that over. My latest indicator that I have on there, my Webonacci thing that we talk about on Fridays, we'll bring that over. And I've got one that I haven't shared with anybody yet, that's built off of that, called my Mojo indicator, that is super exciting. And I think one of the best things that will end up sharing with folks. And so we'll get all those things in there now that we have this new foundation. Now, on top of that, every aspect of the trading we want to improve upon. So what comes to the surface? So different ways of screening in there, which would get at the heart of the screens behind the growth 250. So with that, there's lots of kind of conditional statements, like it has to have this and this, or it can have this or this. It can have this, but it can't have this. all those types of ways that is the kind of the secret sauce behind the scenes with the Growth 250 of being able to bring those things out to people on our platform with screening. So that's on the list there as far as with the charts and everything, just ways of visualizing anything that you can think of. And so some of the things that I had built before that I want to rebuild are what's the best in the group. So right now we've got that little thing in the bottom that says, okay, the top, top 5 stocks in the group by RS. But I had built out this other thing for Bill and I to use. It was only the two of us that would use it, that would go through the group or the sector and say, okay, what is the best one in there? And it's not off of one data item. It's off of, okay, well, out of that group is this one's got the best composite, this one's got the best EPS, this one's got the best fill in the blank, and bringing those up to the surface, because it's about getting good ideas in front of you. So that's just a little bit of the things that I want to do. We'd probably be here for another
Yeah.
3 hours if I told you more, but we just have to build them one by one, and you can't.
Yes.
There's not one person that can build it, because you need programmers, you need people to QA it, you need the customer service folks to answer the questions when people are concerned. So it's all a big team here, and then we're all rowing in the same direction, and we're just trying to save people time and make them money.
Yeah. And I guess what I was trying to get at was just more conceptually to end things on the built by and for
Oh, I'm
concept
so sorry.
that's near and dear to you.
I'm so sorry, Allie. It's been a long day for me. So when Bill Wood came up with his core thing, before there was online stuff, there were these 2 printed books. The maroon, we call them the maroon books, but they're the data graph books, and that's what we would use every weekend. It was this big, this 2 volumes, this high. We get them delivered every weekend. And on the top of it, it said made by portfolio managers for portfolio managers. And that mindset always stuck with me, is that you're building it the way you want to use it. That's how Bill designed everything. He didn't go and say, okay, I'm going to survey 15 different people or 50,000 different people and ask them what they want. He said, okay, what do I need in front of me to help make my decisions? And that's the lens that he looked at everything through. And that's the lens how I have always looked at things through, is just saying, okay, what do we really need? And that's where the core of each one of these changes that we've made, like the pattern recs, making it more consistent of where they start, having the earlier pivot to make it, also easier to understand. All the Growth 250 changes that we made with, the accordion nature of it, as well as leaning heavily on the RS line, moving averages, ATRs, other bells and whistles that have to be kept secret. But then with the ratings, the most important thing, and if Bill were with us now, I know he would be on board. In fact, he would say, tighten up that universe even more, which is something we will do in the future. But again, we just wanted people to get used to it. And so it's that mindset of saying, I want to create something that I want to use and then share it with everybody. And that's something we got from him, and something we are just continuing on with these advancements.
Absolutely. Well, thank you so much, Webby, for that comprehensive overview of what's to come. And we know that there's more where that came from. So it's all very exciting. Thanks once again. And thanks everyone for watching. Happy trading. And we'll see you next time.